Mike, happy 2026. How's your 2026 started off so far?
It started off quite well. Actually, 2025 ended pretty well too, I have to say. My wife, my older son, and one of my older son's friends and I, we went to Hawaii for a week through Christmas, which was nice. And then one of my best friends in the world, um, his daughter got married this past week in Austin, Texas. So I literally just got back from Austin. So yeah, it's been a nice time.
I'm going to go ahead and ask you what was probably the top question I got from my audience, which was, would YieldMax consider, and this is an ULTY question, would YieldMax consider reducing the management fee on ULTY until there's a price improvement? Probably they didn't have a specific number, but say like $40, 45, maybe around 50. Is that something they consider? And I think the reason they're asking is, and I want to know too, is the management fee is definitely high for a lot of ETFs, maybe not in that space, but certainly high, but they're not seeing strong total return performance. So is
Well,
that
to your point, I guess the first thing I would say is that to your point, total returns are really the way to measure how these things are doing. Alti obviously has ridden a little bit of an investment cycle's performance if we think about it like this. Alti's performance was great, obviously coming out of the post-Liberation Day period, and it struggled once Bitcoin really started to roll over in early October of last year. One of the things I've described, and I think I described it to you, but I actually have some stuff I could share if we're interested, was that it was not a Bitcoin heavy portfolio per se, but one of the things that happened at the tail end of last year was that a lot of high beta trades, and that tended to be high volatility stocks, that their correlations really shot up quite a lot as Bitcoin rolled over. And we went, at least at the riskiest end of the market, if we'll call it that, to more of a risk-off environment, and that ended up impacting returns. The strategy has been adjusted a bit since then in the event that the landscape changes somewhat. I will tell you that part of the reason the fees are structured the way they are has a lot to do with how involved the strategy is. And Ulti is a pretty involved strategy. The investment team that works on it is a lot bigger and probably more involved than most people realize. The reason I mention that is because you look up a filing like a prospectus or something like that, and you say, oh well, here's a fund manager, or there's two fund managers. Alti has an entire investment committee of people. The fund managers are two of the 52 people on the investment team over here at this firm that are involved with Alti, but they are not the only two. They are two of many. And as somebody who sits in on the Alti investment committee meetings, I can tell you that it's a non-trivial exercise. Would the partners of the firm contemplate changing the fees? I'm assuming they would. I assume they adapt to any and all business conditions as they deem appropriate. But they're also going to evaluate, okay, what's the appropriate amount for us to charge, given what's going into this. I mean, Alti. One way I would describe Alti is that of all of the various products that are inside the umbrella of YieldMax, which has I think 60 funds at this point, if we include the international ones, and Title more broadly, that is the one that has as much involvement, I would say, from the investment team as a hedge fund typically would, because you have more flexibility with option strategy. It's quite actively traded, and there's a lot of security selection process and risk management that goes into it. So I'm sure they would contemplate it. If they haven't told me, but that's a little outside my pay grade, to be honest. But I also think that the fees, from what I've seen, I used to work at a hedge fund, a typical 2 and 20 kind of arrangement, and from what I've seen, I think the fees are very consistent with the work that's being done inside there.
Yeah, I think though in some hedge funds, when performance is negative, sometimes the manager will waive the performance fee until they come back to par, come back to even. Is that something you think the managers of YieldMax ULTY would be receptive to? And if so, how do we get this message to them?
Yeah, so, well, first of all, fee structures inside of 40 Act funds, of which ETFs are a subset, are not as flexible as hedge fund fees are. So, for example, they don't get performance fees
Right.
when it hammers it out of the park. And there were periods when the fund did very well, that fund and others. And had they been structured as hedge funds, the fees would have been enormous, I think it's safe to say.
Yeah.
Probably in the case of Misty in 2024, for example, that would have been probably 9 figures, I would guess. So it would have been a huge number. Now, I believe, and this is not my area of expertise, like the regulatory framework that surrounds fees or making adjustments to them. I believe there is something called a fulcrum fee, which exhibits some of the characteristics that you suggest, which is that the fee is going to be, one level based on performance that is above some number, and can be a number that is lower if the performance is lower. And I believe that those are acceptable in a 40 Act context. And whether they are used in an ETF, I don't actually know. It's an interesting question. Like I said, I haven't been a part of those conversations, so I can't say, but I am sure that like I said, they're always evaluating the business. They're always evaluating the performance. I mean, the performance is something that is observable daily. And they're trying to not only manage the assets to the best of their ability, but, to do so in a way that is attractive to investors. There's not really much sense in running a fund if people aren't interested in investing in it.
Yeah. And there's definitely, interest in it. I think it's like your third largest YieldMax fund, third or fourth these days.
Yeah, I don't know the exact ranking right now, but it would be right up there. And I think we had some modest inflows last week. So I'm hopeful that some of the changes that have been taking place are getting noticed and that people like the direction.
Yeah. Speaking of those changes, I read in the prospectus that was updated, I think around December 8th, when you guys, announced that you're changing the stock selection process and adding kind of a new layer to the option strategy. I read that 2 of the original PMs, Mike Venuto and Chris Mullen, were replaced with Quinn and Scott Snyder. Can you comment on that? Why that is, or why that happened, if you know at all?
Yeah, it's a nothing burger. Like I said, the LT Investment Committee is a big group. The top of the LT Investment Committee is Mike Venuto. It was and still is.
Okay.
So when it comes to, so first of all, you have the fund managers that take certain responsibilities from a regulatory point of view. And then, so if you kind of imagine that you have the CIO at the top, and then maybe you have some strategists, analysts, and advisors who are sort of in that person's ear from the side. Well, but don't actually pull the trigger on trades. I'm in that camp, by the way. Then you have the head of trading, Jay Petrocelli, and then basically the lead day-to-day trader, who is Scott Snyder. Then you have traders whose responsibility it is to oversee the activities of specific funds each and every day. Quinn is basically the lead on that, where ULTY is concerned. Other people that are involved in the process include folks like Dan Weiskopf and others. That's why I'm saying, when people look at the prospectus and they're like, oh, I think I know what's going on in there. No. Fund management, you said you worked in wealth management, so you can imagine that portfolios, it's not just like some guy who's, walks in one day and decides they're going to do this or that. The traders have discretion on how they can affect trades, within certain parameter sets. I'll give you an example. So once they know that we're going to be adding a stock, they will say, okay, we're going to add this stock and in this percentage of the fund. So let's say, Alphabet gets added. We buy $50 million worth of Alphabet. We know essentially what the yield target for the option strategy is. The stock is moving around. Who's going to decide which options, which call spread, for example, might be sold as an overlay against Alphabet? Well, it's not going to be the CIO or maybe even the PM. At the time, it could be the trader whose job it is to affect that trade at that moment, because they're the ones that actually have their hands on it and are dealing with the changes in the market. So, let's think about it this way, like the investment process statement. So that the IPS document is written by the CIO. So the CIO says, this is what we're going to do. This is how the fund is going to be structured. From there, the investment team comes up with a process for stock selection and stock ranking. What that means is these stocks are eligible for inclusion, and ranking is going to have two impacts. One of those impacts is going to be portfolio constituent weight. You put more money behind the ideas that you have the greatest conviction in, right? So you will see some positions might be slightly larger. Now, of course, positions can grow and shrink as a function of changes in underlying securities prices, but that's a part of it. But the other reason you want to have a ranking is because if you have a name that's, falling down on the list and you have something else that's rising, now okay, we want to add this name and we want to drop that one. So you end up freeing up capital by reducing a position in a stock and going into that. Or new capital comes into the fund. What's it going to be added to? Or there's going to be a redemption or a distribution. You need to free up cash. What's going to be taken off? So all of those things play into it. On top of that, you have sort of like a broader sort of risk framework that you're willing to accept. Consider what happened, as we were just talking about it, after early October when we saw correlations shoot up, right? So you don't want to have a basket of stocks that are highly correlated with one another, and correlations change. They did then. The constituents of ULTY didn't have particularly high pairwise correlations in the 5 weeks preceding the zenith of the fund on, I think it was like October 8th or something like that. But they had very high pairwise correlations coming out. So that has to be monitored. And so you have a non-correlated sleeve, you have the securities rankings, securities weightings, and then you have the discretion of the traders as to the options overlays. So I think you can begin to understand that, there can sometimes be like a facile understanding, I think, of how money gets managed. But, I think there's a little bit more to it than that.
Yeah. And that's why we do these interviews and investor education. It helps me understand. I mean, when I saw that, I kind of read into it. And, when I see that along with the prospectus change in how they select stocks, it kind of makes me think, I'm not saying Mike Venuto was fired because he still works there, but it just seems more than coincidental that two big changes to the strategy happen at the same time the PMs are replaced. So
yeah, so Mike he's the CIO. So if you kind of think of the pyramid, the hierarchy of ULTY's investment decision making, I kind of think of him as at the top of it.
okay. So I guess saying it back to you this way, if someone held ULTY from the beginning when Mike was a PM and they were unhappy with the performance, and then they see Mike is no longer a PM, but he's still there, they might still think ULTY is not a good investment for them if they just don't like Mike Venuto's decision making it.
Actually, I would actually frame it a little bit differently, is that the investment policy statement changed, and that was the reason for the sticker on the prospectus. And some of those strategy changes were implemented at that time. I would actually say that the traders, to some extent, had greater discretion before these events took place than they did after, with respect to security selection. So that the security selection that's going in there has been codified a little bit more, I would say, than it was in the past. So yeah, I wouldn't agree with that, really. And actually, anybody who's observing, and I know you are because you read all of these documents and you also see the holdings of the fund. I mean, would you say that the fund is being managed the same way now as it was 3-4 months ago? I think I already know your answer, but you, no, the answer is it isn't.
I agree. I think that the new inception date or the new strategy change took place roughly to me on November 13th, because that's when I saw the first instance of buying, I guess, NVIDIA or QQQ or Costco, and in some cases also doubling the number of puts that you bought, which was part of the new option strategy, while still maintaining the traditional collar. So I'm measuring it from the 13th of November, when I first saw that, to now. And since then, it's been fairly stable, and the names have definitely changed.
Yeah, I think that's a fair statement. Was the 13th a Thursday, a Friday? It was around that time because Alphabet got added.
It was right
Around
around the
that
time
time.
we did our last interview, actually.
Yeah, yeah. So it's interesting. Obviously there's the documents had to get through legal and, to get the new filing out there. There actually was enough flexibility built into the prospectus ahead of time. Um, there was discretion. It's a discretionary fund, right? It's an actively managed discretionary fund. So there was flexibility enough to make some changes in one or two securities. And to your point, and like I said, you were very observant. You're paying attention to what's going on in there. There were a lot of cross currents, things that were happening simultaneously. But one of them was that the holdings, the stock selections began to change even before the prospectus got out. And they were, like I said, they were consistent with what the prospectus said earlier. But, the change in the prospectus sort of highlighted and described how the investment process was going to change at a higher level. And, I think the important thing, and Jay will say this often as well, ULTY hasn't forgotten what it's about, which is trying to, the ultimate yield, if you will, and trying to generate that. But in order to do that, you also have to have, some sort of persistent non-correlation, which is a different thing than anti-correlation. And I think we may have discussed this before, but non-correlation in the assets. So having a non-correlated sleeve, that's where some of the GDX is coming from. That's where some of these other names that you just mentioned. And there have been rotations into and out of them. There was a rotation into Micron, for example. That was one of the stocks that was in there. You pointed out Costco. Costco, not a very high volatility name, so it tends to be a little bit more challenging to get a lot of premium out of a name like Costco. But yeah, I mean, the observations you made, I think, are well worth taking a look at. And I think that the change to the prospectus just basically sort of makes it clear to investors what the objective is there.
Okay. And one other question I got from from my audience was, would ULTY ever consider doing zero DTE options in the strategy?
So, well, first of all, zero DTEs are in the index space, right? So we don't have zero DTEs on the single names. And generally speaking, the constituent stocks of ULTY are single stocks. When you don't see single stocks in there, so you see other exchange traded products, let's say GDX, for example, or something like that, that's usually more of a placeholder. This is, a broad portfolio level determination that's been made. You want to have exposure to this, call it industry, sector, space, whatever, basically for the benefit of the broader portfolio. And something like that could happen as you're transitioning into some of the individual stocks. Now, there are a couple of reasons why something like that might happen. One could be, we need exposure to this sector or industry. We need that to happen immediately, and we haven't identified stocks. Another reason that can happen is because you need to make sure that you have suitable liquidity in the underlying stock and options so that you don't have any slippage associated with entering or exiting the positions. So that gives you an opportunity. So let's say, for example, I have, right now we have about $1 billion or so, maybe a little bit more in the fund. But if you got up to 10 billion, and you figured that your position sizes are going to range from 2.5% to 5%, those are big positions that you're going to be entering into, right? So that's $250 to $500 million per name, let's say. At times you might find better liquidity in some of those proxies, and then you can rotate in as the traders see fit into or out of positions. So there are a lot of reasons why you want to preserve that flexibility, and some of the reasons why you might see something like that over and above trying to have the portfolio constructed in a way that's consistent with your investment philosophy, beliefs, and positioning.
Okay. Another question about option strategies that came from the audience was, would ULTY consider doing something similar to the wheel strategy where you sell a cash secured put on a underlying holding that you like, and then it gets assigned, great. Now you own it, but you collected income on the way to owning it. Is that something ULTY has the flexibility to do? And if so, would they consider it?
It doesn't, and it actually has. So it has done
Okay.
it. So if you actually look back on a couple of the positions that were entered, one of the things you'll observe is that there might have been sort of a core underlying equity position, maybe a short call spread on top of that, and maybe also a short put spread as well. I'm sure if you've been looking at the positions, you've seen that kind of thing. So the short put spread is essentially selling a cash covered put with some insurance on it, if you think about it that way. So if you're saying, okay, well, I would own up to, and I think the biggest position allocation I've seen was just north of 6% recently. But if you had like a 4% allocation to, say, Alphabet, I'll just use that as an example, but I think it's illustrative. And you say, well, we like the stock here, we'd like it more at a discount to where it's currently trading, so we're going to enter into it at something less than the largest position size. We are going to sell some upside calls or call spreads against that. And then maybe we sell some puts at a level where we would be comfortable with or would like to add more to the position. The downside puts, whether it's against equity or against other short puts, is really, a form of insurance, a collared stock position effectively. But yeah, I would actually argue that, the wheel, when most people think about the wheel, it's a relatively simple thing. I sell cash covered puts. If I'm put the stock, I sell calls. If I get called out, I go back to selling puts, and so on. If you're looking at ULTY, most of these positions have more than a single leg against them. And in many cases, you might see, there would be instances, and I'm sure you've seen this, where there's a core underlying stock position, and there might be two different sets of short call spreads and maybe a short put spread or a long put. ULTY has a decent amount of flexibility, and the traders and the PMs have some flexibility about how they can implement that. Consistent obviously with making sure that you're adhering to the RIC rules.
Okay. One of my audience who actually has a few thousand shares of ULTY, he asked, does ULTY distribute the dividends it receives from the underlying holdings? I think I know the answer, but he highlighted Broadcom as one. They paid a dividend, I think, in December. And I think from his calculations, I didn't get full details, but they may not have included that. So can you comment on that?
Yeah, so dividends, interest, realized gains, all of that factors into the total returns of the fund, and the distributions are made based on the manager's determination of what's appropriate given the total return. So the short version is that, of course, the dividends go into the value of the fund and will be, thought of as a portion of the value of total returns that should be distributed. So the short version of that is yes. And to put things actually a little bit more plainly, let's imagine, for example, that all we did was own stocks. And those stocks, some of them pay dividends. We actually need to distribute at least 90% of the received dividends throughout the tax period, or else it's going to impose a negative tax consequence on the fund. So in order to maintain the pass-through status, which is something we keep coming back to, but you have to distribute 90% of the realized gains, interest, income, and so on within the tax period.
Okay, so maybe I'll connect you with him. I'll ask his permission if that's okay.
Of course.
Cool. Because I think his concern was, Broadcom's dividend was not paid out in the ULTY distribution. It sounds like it should have been and was.
Yeah, all of that goes into the fund, and then distributions are made from that, right? So those distributions can come from interest on cash balances, it can come from dividends and realized gains. And in fact, actually, you can make a distribution even if you have unrealized gains. If you have unrealized gains and you make a distribution commensurate with those gains, that'll show up as a return of capital. So as a non-ordinary dividend or distribution is what's going to show up on your 1099 DIV. But the fund cannot retain 10% or more of whatever realized gains, interest, dividend income that it may receive, or else it's going to be subject to tax itself as an entity. So you don't want to do that.
Right. And does that then mean that you'll never reinvest the dividends of an underlying holding?
You can reinvest it if you have an offsetting taxable loss. So the way to think about it is this, right? if you have if you have realized gains, interest, or income in the fund, 90% of that has to be distributed. So if the only thing I ever did was bought 100 shares of $100 stock, so that's $10,000, and let's say that stock paid a 4% dividend within the year, $3.60 of that, 3.6% would have to be distributed, or otherwise you'd be subject to a corporate tax at the fund level, which you don't want. Okay, alternatively, let's say that that fund, the stock that it bought, appreciated, and you sold that stock for a 10% gain. Well, you have to distribute at least 9% of the 10%, or you will be subject to tax. Now, on the other hand, what happens if I get that same gain and I distribute that gain, but I haven't realized it at the time? Well, that's going to come back to you as a return of capital, and the shares are going to basically go back to their prevailing price ahead of time. And I think it's sort of the interplay of these things that can sometimes get a little bit confusing. Now let's imagine that the stock paid a dividend, but I realized a loss of the same amount by trading securities inside the fund. Well, now I could retain that dividend in theory if I wanted to, and will not be subject to tax because I don't actually have a taxable gain on balance. I have income of however many dollars, and I have an offsetting realized loss of however many dollars. So that also will play into it. But effectively, if you have realized gains, that's what you can't retain. You can retain a very small de minimis portion of it, but 90% has to be passed back, because if you don't do that, then you get subject to tax.
Okay.
So it's a double taxation problem. You don't want to have that happen. And that's the reason why, by the way, if an investor gets those things, that it's better for them to get it and reinvest and bump their basis up than for us to retain it. Because you end up in a situation where the taxes could be greater if we did that, because individuals could also have an offsetting tax. So if we don't have a realizable loss, but you do, and we made the determination, we're not going to pass anything back, and we're just going to pay taxes at the corporate level, 30%. Now your gains are being subjected to a 30% tax, whereas maybe if they'd been distributed to you, you wouldn't have had any, right? At the worst case, it's always better to give that discretion probably to the investor than for the fund manager to make an arbitrary decision. So they're preserving the pass-through status. That's an important element of this.
Gotcha. I now wanted to talk about the recent reverse split. One of the audience asked, what's to stop ULTY from just continuing to reverse split? Because I think when it launched, the price was maybe around $20 a share, I want to say. So
that could be right. I don't actually know what the initial price was. So is there any prohibition necessarily? And actually, I'm actually taking a look at late November. I'm actually curious to see what the returns were since then, because that's sort of something worth thinking about. So a reverse split takes place when the price of the underpinning shares get to a level where we think that on balance, investors are going to be better off if the shares are reverse split. What could some of those reasons be? If there is a maintenance requirement at the brokerages, such that you essentially have to pay to hold the shares, that's not in investors' best interest, and we should probably do something to resolve that. Ideally, if the investment performance is good enough, that shouldn't be necessary, even net of the fact that you have to pay back all gains that you make, all realized gains, right? So for the reasons we were previously discussing, one of the things that keeps a lid on some of these strategies, the stock price, is number one, the fact that you're paying out very big distributions. And then the reason for those distributions is so that, you're trying to preserve the best tax efficiency that you can. That is on top of the fact that these things are called YieldMax products, which means you're supposed to be distributing as much as you can anyway, right? So I would just offer that when you do that, the amount of capital appreciation these things are likely to see isn't going to be too big because you're passing back the gains. On the other hand, we do know that you can have very attractive investments that have respectable distributions and also get capital appreciation. I mean, that's more in the target 12s, which aren't really focusing on maximizing that distribution. So some of those funds have actually seen good capital appreciation and obviously much more modest distributions. So it is possible to get capital appreciation, but you have to do it within that other framework that I was talking about. So you have to adhere to all of the RIC rules, you have to adhere to the IRS rules, and if you do that, it's significant price appreciation in the shares is not going to be as likely in the products that obviously pay out more. I mean, I guess that makes intuitive sense. I hope it does.
Yeah, yeah. Well, if I set it back to you, let's say ULTY's paying out 1% per week, the fund's going to decline, by 1% a week because the cash in the fund is being distributed to investors.
Yeah, on all else equal, any security that pays a distribution is going to decline by the amount of the distribution on the time that it makes it. Ideally, the value, the total returns of that underlying instrument are rising by the amount of the distribution, or maybe in some cases they might be appreciating even faster than that. I've often said on a lot of calls that my ideal product would appreciate at least as fast as the pace of inflation does, and then would make distributions, above and beyond that. And hopefully those distributions are return of capital, so that's just basically lowering the basis. So you essentially are accumulating a deferred unrealized capital gain. That would be the ideal circumstance, and that's really what the managers are attempting to do. Which is get the best total returns that they can and do it in the most tax efficient manner they possibly can as well. There are limitations to how much you can do that. I mean, there are things you can do and there are some things you can't do. There are circumstances where sometimes you might have an appreciated position inside a fund where it has grown to a point where you actually have to realize the gains, or else you're going to, say, violate a concentration rule. This is one of the things that happened in Misty, for example, back in 2024. There was a huge rally in Bitcoin tail end of 2024, as you know. Strategy, now called Strategy, it was called MicroStrategy at the time, rallied very sharply, and the combo, of course, appreciated in value significantly. Now, you have concentration limits, right? You can't have more than 25% of the value of the fund in any given security. And if you have a stock that has gone up 100+% and you own calls in that stock, and it's a single name fund, there's a good chance that you now have a situation where you must realize profits. You have to sell those calls. You have to rotate up and out of that combo because you have a concentration issue. And so you're compelled to take those gains and realize them. Something that doesn't happen in a really big fund, like if you own SPY, for example, doesn't really matter how big NVIDIA gets. I mean, I suppose, is there a circumstance where NVIDIA became 25% of the S&P? I mean, theoretically, it's possible. It's not going to happen. But those are the types of things that force a manager to realize gains. And in that instance, then you're going to see what we're talking about. You're going to see a big distribution, and it's not going to come back as rock, most likely. But and another way to think about that is that those can be good problems to have, right? In some ways, we should hope that you get big distributions and you have capital appreciation in the share price, and some of it's going to be taxable because there was just too much money being made. So, that it's one of those things. Big tax bills sometimes can be a good problem.
Sure. Yeah. Going back to your comment about an ideal product that grows at the rate of inflation, or maybe at the rate of the GDP, that would be nice, and throws off an income on top.
Inflation, I think, has been higher than GDP for several of the past several years, unfortunately. Maybe not the headline figure, but the real number has been higher. Certainly was during 21 to, from 2021 until, probably a couple months, I would say, before the end of the last administration, the real inflation numbers were high single digits. And, not even nominal GDP growth was wasn't even half of that.
It's a good observation. It's a good point. But should someone then kind of, if they look at ULTY and they go on the website and they say, okay, it's distributing 65% or has a 65% yield, they should not expect that you put in $100 on January 1st and then on December 31st, the price is still $100, but they've distributed 65. Like that's just,
yeah, I don't think
that's unrealistic, right?
I think that's unrealistic. Now, I will say, is it possible that you can get exceptional performance like that over a period of time? And the short version is, it is, but a lot of things have to go right. Look at something like CHPY, for example, which is, it started trading in early April of last year.
Do you have it on screen? Or all right, so at this point in the interview, Mike and I started talking about S&P 500 covered call ETFs like BIGY, like JEPI, the JP Morgan one, and like SPYI, the NEOS fund. So we focused a lot on his Bloomberg terminal, and I realized that people are probably watching this video for the ULTY information. So if you want to skip ahead to 51 minutes, the 51-minute mark exactly, that's when we come back and start talking about ULTY. If not, and you are interested in S&P 500 covered call funds, keep watching. Thanks.
I do, actually. I can share it if you want. Yeah, okay, let's do that. I'll share this. Let me just... Forgive me, just make sure I get this to the right spot. And what are we looking at? Hopefully, you see CHPY up here now.
Yep.
Okay, so launched in early April. And since that time, the share price, that's this number over here, the share price is up a little over 31%. If you had taken the dividends and reinvested it, you'd be up 77%, which is up over 100% annualized. And if you had simply just taken the cash distributions, you would have gotten about 36% in cash dividends, and you would still also have the share price up, 31.4% over that same period of time. I don't know exactly what SOXY's numbers are, but let's just take a quick peek. SOXY's even better, right? So share price is up 63%. You'd have gotten, in this case, much smaller distributions because this is a target 12, pays out 1% a month. But, you'd have gotten 13% in dividends if you'd taken them in cash. If you had reinvested those dividends, you'd be up 78% in total returns. But you had a big significant increase in the share price. So is it possible to have, funds that are up 65% in a year? Well, I just showed you two that are up more than 65% in less than a year that we manage, that pay big distributions. But is that what people should expect in general? And this is exceptional. And it's exceptional because they were in the hottest space in 2025. The AI trade was the hottest trade of the year, and these are both in it for good size. So they benefited. Someone could have bought, the Bitcoin trade did not work out so hot in 2025. And, if you look at a name like Moderna did not do particularly well either. So if you do, no options trade is going to fix that issue. So, invest first in themes that you like and then put an options overlay strategy on top of it. I think that one of the reasons I like to talk about BIGY a lot is because BIGY is basically the S&P, right? So if we go back to its inception, I'm trying to remember what this will just kick back to. So this was, that's not right. That's not our fund. That's a Canadian stock named BIGY.
No, the CN one. Yeah.
I was looking at that. I was like, that's not, what is that? Okay, so BIGY was created, it first started trading in November of last year. But the thing that's most important about it is that this behaves a lot like the S&P does more generally, except that it pays 1% per month. So if you take a look at its performance, you will find that its drawdowns and its total returns and its risk characteristics, all of that is not dissimilar to the S&P more broadly. But the S&P doesn't pay out 1% a month. If you take a look at this through the end of the year, which we can do right now, and I'm actually going to do it just for the year. So we're only going to look at it for the full year of 2025. So from December 31st of 2024 through December 31st of 2025, these are the numbers, right? So what did you get if you had bought it? You got a 4.5% appreciation in the stock price. If you had reinvested your dividends, you'd be at 19%. And if you had simply just taken those distributions, you'd be at 17.8%. And we can compare that to, something like SPY, which is, I think, probably the proxy that most people are familiar with. And what you're going to see is that there you had a 16% appreciation in the share price. If you'd reinvested the dividends, you'd be up 17.7%. So net of fees, BIGY outperformed on a total return basis. No, no meaningful distributions, right? Because this thing only pays whatever the current div yield for SPY is. It's probably well less than 2% at this point, I would guess. Let's take a look. 1.15, right? So, it's a little bit, I think that the BIGY product, the thing that's interesting about it is because there's no discretion with respect to the security selection. It's cap weighted, top 50. It kind of tells you how the strategy works. But in order for the strategy to work particularly well, the underlying securities in the fund also have to do well, right? That's your long stocks generally, unless it's like salty. There's some bearish ones too. So if you could take a look at Misty, or you can take a look at the short fund that's on the opposite side of it. Same thing with Crash and Tesla and so on. So if you look at Winter, that's the other thing that kind of speaks to the strategy. If you look at Winter and Misty side by side, the example I like to provide is that, and I'm not going to go back to early October, I'm going to go back a little bit further, but if I'm looking at Misty, I'm going to go back to July 16th. And the reason I go back to July 16th is that July 16th of 2025 was when strategy stock hit its highs for the year. And look at these performance numbers since then. This is, not great, right? Nobody wants to put their money in and say, oh, I put $100 in and I've got $26 and change in the share price left. And if I had simply taken the cash, I put $100 in and I've only got $51 and change left because the total returns are minus 49%. On the other hand, had I, gone into MicroStrategy at the same time, unfortunately, it's considerably worse, right? Down 64.4% over that same period. Actually, did that go to the end of the year? It meant to. I'm going to put that in there anyway. 66.7% from July 16th. On the other hand, if you then take a look at Winter, which is the short variant over that same period, and that's up 82.6%. So if you had been long Misty, which is short MicroStrategy selling upside call spreads, but also long Winter in equal measure, over the course of this period from July 16th through the end of the year, you'd actually be up money on balance being long both. You would have lost 49% in one, and you would have made 82.6% in the other. Mm-hmm. So, you put the two together, and you get your real number. Now, by the way, when you do that, think about it this way, right? So it's not 82.5%, to the good, and then, whatever, we'll call it 40. Let's use round numbers. We'll just call it 82 and 48, just to keep the math easy. So what this means is if I put $100 into this, I'd have $182 now. And if I put $100 into the other, I'd have $52 in that now, right? So I put the two together, 52 and 182, and now I'm, up to $232. So that means I would have made $234 means I made $34 on $200 invested, or about 17%, if that makes sense. Round numbers.
Sure. Sure. I do want to ask though about BIGY, because if you're saying it's like the S&P 500 with covered calls, there are a lot of products out there that do something very similar to that, like JEPI from JP Morgan or SPYI from Neos. What are the differences between these? I mean, I guess BIGY has what, the top 50 versus
I mean,
actually
they're going to
holding it.
behave, they're going to, one thing, I think this is an important point. The top 50 in terms of market capitalization of the S&P 500 basically is the S&P 500 because they represent such a huge percentage. And you're right. I mean, so JEPI competes, and here we're looking at JEPI's return. So JEPI from December 2024 to December 2025, share price was unchanged, right? And if you had just taken the distributions in cash, you made 7.8% in the year. It's not a terrible result. If you'd reinvested in the fund, you'd be up 8.1%. Again, it's not the end of the world if you make 8% in a year, but that doesn't really compete with, it went back to that Canadian stock. Why does it even do that? I've got to exclude that.
Is it possible to overlay these two and compare them in the same chart?
BIGY and JEPI? Sure.
Yeah.
So I'm going to do this. All right. So I'm going to put JEPI in here. Now, what I'm going to do is, you have to just bear with me for a second. So I'm going to look at just last year. I think let's look at the full calendar year. So that's the first thing I have to do is adjust this. The other thing is you're just looking at price. So I have to actually look at it on a total return basis, of course. No sense looking at funds that focus on making distributions and comparing them.
Right.
So I'm going to do the same thing here. And then we have to normalize that. And now I'm going to flip it and say, okay, if you bought BIGY and sold JEPI. So this is the spread, right? So the white one is BIGY and total returns. And the orange one is JEPI. Again, total returns. And the relative performance is here below. So BIGY outperformed JEPI by about 11%. Total returns last year.
Okay. And what about, can you do SPYI, the Neos one? Because I think my audience is invested in some Neos funds. So can we do that comparison?
Sure. What is it?
SPYI. Spider Income, I guess.
That's fun. Income ETF. Let's see. Yes. I'm going to quickly, SPYI, you said?
Yeah.
I'm curious to see what's in that as well. Is that levered by any chance?
I don't believe it's levered. I think it is just covered calls on the index calls, but they own all 500 stocks. But let me check though.
Okay. Well,
I'm not personally invested in it.
All right. Well, here's the relative performance. So again, you've got BIGY in white. And you've got SPYI in orange. So SPYI did better than JEPI did. It did not do as well as BIGY did. So it underperformed us by about 243 basis points. So they had decent performance.
Yeah. So why would the Neos fund be so much larger? Because BIGY is not your guys' biggest fund.
Have you
guys speculated on that?
I'm a little. So I think the Neos fund did they launch before ours did?
They're 2024. I know that. I'm on their website now. They are 2022. Excuse me. 2022.
There's your answer. So I think I'm imagining that, when you have a fund that's started earlier, it's got a head start, right?
Mhm.
Um, but maybe our better performance will attract some investors and they'll rotate into it once they become aware. I think, one of the problems that also happens is that there is a tendency, I think, for investors, and I think we're all guilty of this to some extent, is that our eye is drawn like the moth to the flame to whatever is hottest right now. So if things like Nvidia are taking off and doing really well, people are going to look at options strategies that focus on Nvidia, like NVIDIA. If Bitcoin is hot and strategy is hot, people are going to look at the options funds that focus on those. S&P 500, because it's not necessarily, people think of that as just the broad market. It's a proxy for the market. So when they're looking at, discretionary investments that they might make, they're probably focusing their time and attention on either companies, sectors, or industries that interest them. And I think, things like BIGY might get overlooked for that reason. But, its performance, in my view, puts it in a pretty good competitive position. Now, awareness is probably the next thing that's going to have to matter, though.
Yeah. Yeah. Okay, cool. Well, I know we have just a few minutes left, or you had to leave at 1:15. Is that right?
Yeah, I have another thing that starts at 1:15, but
Sure.
I'm happy to push it a little past the top of the hour so we can maybe get to 1:05 my time, 1:10. I'm
Oh,
on the West Coast for those that don't know.
yeah. I'm just looking over to see if I missed any questions from the audience. I think we kind of addressed this one, but someone had asked, is ULTY going to be a fund that appreciates in price slowly, or do you guys desire for it to be more like a bond where the price is fairly stable and it's just throwing off uh, the weekly
We're
distributions?
trying to maximize the distributions in that one. I think if we're looking at single names, so it's going to take some time before a target 25 fund of funds could exist. For example, I think the target 12s, obviously, they're looking for a balance of capital appreciation and distributions when markets allow. Now, bear in mind, part of this is going to come from what equities do more broadly, right? So it would be great if semiconductors continued to rip the way they have done. And that's going to be great for funds that we trade that include both of them, including SOXY and CHPY. And if the market continues to do well, it did very well last year. It did very well the year before that. We have to go back to 2022 to find a year where equities haven't done so well. And because we own these underlying stocks, that's going to have an impact on returns. But I actually would argue that I think BIGY has done exceptionally well. I don't understand why it hasn't attracted more assets, which I guess was your question, but I'm guessing maybe just a little bit later to market. People aren't aware of it. We have, like I said, between the stuff in the United States and internationally, 60 plus funds at this point, and there will be more. And my hope and expectation is that we end up, finding products that suit each investor's needs. Some people are focusing more on immediate distributions, others on capital appreciation. And if we have a full product suite, I'm going to assume that hopefully we have diversified baskets that meet the needs of, that entire spectrum of investors.
Yeah. Just when I've looked at the demographics that YouTube shows me on my audience, they're mostly over 50, and a lot of the comments are 50 and in the US. But a lot of the comments are people who are focused on income and could be retirees or, you know, self-directed investors.
They're closer to my age than yours, in other words.
Yeah, that's right. And they are
I'm over
focused on
50. I'm in my 50s. So
yeah, they're focused on the income, but they're also very, aware of the price, and that's where ULTY's been a bit of a disappointment because the sticker has a very high income on it. It's in the name, ultra income, but the price has gone down, and that's not something they're comfortable with if it's going to be, a certain percentage of their retirement income.
Yeah, and it's interesting that you mentioned that because, just taking a look at, I mean, the income has come in a little bit late. That's a function of more than one thing, it should be said. I mean, it is conventional at the end of the year for volatility to be a little bit lower, implied volatilities. That's partially because you have fewer trading days, right? So
Sure.
the week of Christmas, usually instead of having 5 full trading days, you have 3.5, and the week of New Year's you have 4 instead of 5 full trading days, and options premiums will be slightly lower to reflect that. I think also as we take a look at ULTY's performance, though, since let's just say we'll split the difference between when the sticker went out on the prospectus and the date when you saw those first changes being made, but the fund hadn't really been adjusted. One of the things you're going to see is that I think that the returns have been pretty good since then. We've been pretty happy with them. I'm actually looking. So the 30th was actually not the end of. So I can either choose December 1st or November 28th. But the returns there are pretty good, I think, since late November on a relative basis compared to the broad market. Now the share price has declined again because of the distribution, but it's the total returns that matter. And it's interesting. I had an opportunity to look at Jay Pestrochelli's holdings recently of YieldMax funds because he owns all of them. He owns every single one, and he has a drip plan that goes into them. Mike Venuto too, and I had a chance to look at his account as well. The reason was because we were trying to figure out what was going on with some of the distributions most recently, and so we wanted to see what different brokers' accounts were showing when there was that little thing that happened, and there was something happened in the settlement process. And some people were getting the distributions on time, and others were getting something that said pending. Mike Venuto, for example, he saw pending on his. He reinvests the dividends. Jay does, all of it. So he just has an automatic drip, and that's when I was also noticing, because I've only bought whole shares of stock myself, and I was seeing the fractional share ownership because that's how it's getting allocated across all the funds in his account out to the 4th decimal places. I found that very interesting because I actually don't manage my own affairs exactly the same way. I'm sure everybody's going to be unique. So that was the first time I'd actually seen that. I was like, oh, so that's how Schwab does their fractional share ownership. And it was only based on his account that I was able to see it. But that is something that investors can and should seriously contemplate. Number one, are you comfortable with the underlying stocks that are being held, and are you comfortable with the strategy? Beyond that, the higher the distributions are, if you feel like you want to have a more consistent NAV, you can reinvest the dividends to maintain the NAV. So if, for example, since December 1st of last year, ULTY shares, the share price is down 3.7%. I'm rounding up. It's actually 3.69. But let's just call it 3.7. Now, this is a period of a month and 12 days, right? But the total returns are 4.3%. So if you had said, okay, well, I want to maintain a constant NAV, take the distribution out, reinvest the balance, and I have the same NAV, and the rest is my income. Now, I realize that creates a little bit more of a maintenance situation on behalf of the investor. Remember that the distributions are being made to adhere, number one, to the name that's on the tin, which is YieldMax, but the second, ultra options income, so you're going to pay as much of it back as you can. But the other is also so that you can handle that tax issue. Now, there are things in terms of portfolio management, realizing gains and losses, that any investor would do in their own portfolio. That is to say, if you're going to take gains at the end of the year, if you have something else where you can take an offsetting loss, chances are you're going to do that so that you don't really, so that you have gains and losses that are offsetting and you don't have an unnecessary tax consequence. Fund managers are going to do that if, when, and where they can. But outside of that, just know that the distributions are going to be maximized. So there is probably in these higher payers going to be a need to reinvest to sort of preserve the NAV, assuming the underpinning assets are doing well. And that's something that I think investors should also pay attention to.
Okay. Great. Well, I think we're wrapping up. I guess my last question is, or comment is, for the retiree or the person who is really focused on creating an income through their portfolio, um, what advice would you give them? And it doesn't have to be specific stocks, because are you allowed to do that or no?
Can I make a specific stock recommendation? Officially, no. I'm not in the business of making official stock recommendations, although you had asked me before we got started today when the CNBC
Yeah.
Fast Money Acronym Challenge is taking place, and I think I'll be talking about some of my ideas for this year. I can speak sort of at a high level, just as an active market participant, not on behalf of the firm or anything like that. My thinking about this is that at everybody's core, you probably want to have some exposure to equities. If you don't have any specific view on what those equities should be, then the underpinning proxy for that should probably be something like a broad index product. So the S&P 500 is as good a proxy for U.S. equities, I think, as any you're going to find. And if income is what you're focused on, in our universe, that product is BIGY, right? So that's going to have equity exposure that is very much in alignment with the S&P 500 more broadly, pays out 1% a month. Outside of that, you can then go ahead and start making your more discretionary investment picks. You like Bitcoin, then that's going to be the Misties and Biddies, that kind of thing in this space, right? You're going to YBIT in the case of instead of IBIT, you could want an income producing fund. Those are the things you would look at. If you believe that the semiconductor trade is going to continue, then that's going to be your Chippy and Soxies and things like that. But at its core, everybody should have some exposure to equities. And the reason for this is that, unfortunately, like it or not, the value of a dollar does not go up over time. And fixed income, over the longer period of time, things like treasury bonds and so on, don't do particularly well on a relative basis. Your total real returns net of inflation are not going to be that good. So you have to have some kind of real assets. Real assets are going to be things like real estate. They are going to be things like stocks. Doesn't mean you can't have some allocation to bonds, because bonds, especially low risk corporates, investment grades, they can pay you an income. But the truth is that their performance over time is really not that great. So I don't really encourage people to over allocate to that.
Okay.
That's
Great.
sort of my high level thinking on this.
Sorry, one more question, because it just occurred to me as you were answering that.
Mm-hmm.
So for ULTY, because that's what I focus on and that's what my audience cares most about. You've said before that if you're bullish on the underlines, this, or if you're not bullish on the underlines, then this is not the fund for you.
Correct.
You have to be bullish on the underlines.
Mm-hmm.
But when you have a fund with such a high turnover where the underlines are constantly changing, you really have to be paying attention closely to it, right? Or how do you think about that?
Well, this actually, I think, that's a great question. And actually, this is where understanding the investment policy and approach of the fund is also going to make some difference. So there is some turnover in the fund constituents. You're going to observe that there is a lot of companies in here that you're already familiar with. So examples, and I apologize, I'm not looking at the camera, it's because I'm looking at the holdings.
Okay.
But Eli Lilly has been in there for some time. Salesforce has been in there for some time. NVIDIA has been in there for some time. Robinhood has been in there for some time. Strategy has been in there for some time. Now, why is it that a lot of these companies are in here? Well, one of the reasons that some of these have been in there for as long as they have is because they adhere to that broader investment policy that Mike Venuto and those that are working with him and the portfolio managers have articulated is important. What are some of those things? In general, you are going to be looking at companies that have growing top line, and that means that their revenue growth is probably outpacing the growth of GDP and probably outpacing that even of the S&P 500, which is typically higher. So if the GDP grows at 3%, commonly the S&P revenues are going to be increasing at 4 or 5+%, and EPS growth is probably growing much faster than that. The CAGR for the EPS in the S&P 500 over the course of the last 10 years has probably been north of 8%. These stocks are all growing faster than that. So that's one thing. Momentum does play up into this a bit too, which is to say this isn't a strategy that's completely doing its stock picking by technical analysis, but technical analysis does matter. Now, there is a carve out for what Mike Venuto calls, special situations, which means that we have a screening process that tries to identify things like I just talked about, which is growth, momentum, the relative value. And what I mean is that these are not value stocks, but we care about price, earnings, and growth. Yeah. So those all play into each other. So Eli Lilly is a really good example of this. Not the cheapest stock in the world, but when you take a look at the growth, it's quite reasonably priced. Same thing with NVIDIA. So those things are going into it. So when you look at this, it's not just about saying, okay, I believe in NVIDIA, I believe in Palantir, I believe in AMAT, I believe in Reddit, I believe in Corning. It is also, I believe in this investment approach. So even if I'm not looking at this all the time, I know that they're going to have a non-correlated sleeve, which includes some of the miners and things like that. So you got copper and gold in here. I believe in trying to identify stocks that, in general, there will be exceptions, in general exhibit positive momentum. I believe in owning stocks that are probably faster growers than the S&P and faster growers than the economy overall. Those are the kinds of stocks that are showing up in here. And when I look at these stocks, do I generally agree with the process that identified them in the first place? If you do agree in that process, then you're exhibiting some faith in Venuto and his team at stock selection. And then I think this is going to be fine, even if you're not sitting there, okay, the new positions are out, I better double check and make sure I'm still good with it, right? So that's more of a process and policy alignment. But yes, I mean, if you look at this and all of a sudden you start seeing names show up and you're like, why is that in there? And I don't like that stock at all, and I don't like 3 or 4 stocks. Well, then chances are something about what you believe is the appropriate investment process, for whatever reason, doesn't align with that of the managers. And then you might want to look elsewhere. I, for one, happen to believe that if you're going to invest in equities, you want to invest in ones that have momentum and are generally growing faster than the economy and faster than most other stocks. Those tend to be higher beta. They tend to be higher vol. And those are the types of names that will show up in here. And they do.
Great. Well, that sets us up for another episode of this. I'd love to talk about those names, or if we could talk with Michael Venuto as well.
The process, I think you'll find very interesting.
Yeah. I mean, I don't know is that document, the IPS, is that something you can make public, or?
Better ask him. It's his document. Sure. I'll ask him. I'll actually see. Maybe it would be fun to get him onto one of these things. And yeah. I don't know if it's a public document. It is one I have seen.
Okay. Maybe even a redacted version that hides some of the secret sauce. That would be cool to see. I think that would be very important for the ULTY holders, or people interested in it.
People should know how their managers think about investing. Warren Buffett and Charlie Munger were never shy about talking about how they thought about investing in businesses for the long term. And they answered questions about it. We like to be fully transparent and answer questions about that too. As far as whether he's going to go completely open kimono on that process, I would guess that there's some things that you would like to preserve about that process. But at a high level, I'm sure he's willing to articulate the things that he thinks are important when it comes to picking stocks. And when you decide that it's time to sell them, whether it's because you have gains or because you just don't like the idea anymore.
Okay, great. Well, Michael Khouw, thank you so much for answering my questions and the questions of my audience. I really appreciate it. Any last thing you want to leave them with?
No, I mean, I appreciate the opportunity. There's always a lot to talk about. We've only scratched the surface, so I'm happy to come back anytime and dig into it. And probably the best way to do that is just carve out a little narrow niche and say, today we're going to talk about this, and dig as far into it as you want to. So rather than going a mile wide and an inch deep, we can go an inch wide and a mile deep.
Sounds good. Cool. I'll end the recording there.